When should you use a single K, also called a solo 401k? When is that better than a 401k? I've got that and more coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. All right, you know what a 401k is, and you know what a single K is, or solo K. It used to be called a KEO plan, okay? But the bigger question is, well, if you know the difference between those two, when should you use a single K? All right, I've got a real life client scenario we just went through this week, changing a few of the details to everything's confidential, right? But it really demonstrates when you would apply and use a single K or solo 401k instead of a regular 401k. All right, so what's the difference? 401k, single K or solo 401k, doesn't really matter what you call it. They're essentially the same thing, except a single K, or I'm just going to call it a single K, all right? That's what we call it over at Korhorn Financial Group. So the single K is designed for someone that's self-employed, okay? It's a 401k plan, has very, very similar rules, meaning same contribution limits and same matching. You can even do a profit share to it. There's even some that have loan provisions or after tax. There's lots of the same features that a 401k would have, except it can only be used for a business where it's just got one employee, okay? And if you have a second employee, but that you're married to that other person, that second employee is your spouse, it'll still apply. As soon as you have an employee that is not your spouse, can't use a single K, all right? But other than that, it's going to work very similar to a 401k. All right, so that's the gist. Here's the real life scenario. Walked in the KFG offices just recently. A married couple, they both have jobs, okay? He's working part-time. He also has his own business, okay? That takes the majority of his time, and he does really well. And his spouse works for that business as well. She's not taking a paycheck, I'll just say that right now. So she helps manage the business and the orders and all that stuff, and she does the bookkeeping, and he's the tradesman. He's the technician. He does the actual work for the business, okay? They've got what they said, this is their own terms, I love it. They've got an investment guy that they like, but after kind of learning a little bit about the 6 areas of financial planning, went to that investment guy and said, listen, we need some tax planning because this business, the income is higher and all of that. Can you help us? And the individual essentially admitted, I'm not able to provide all 6 areas of comprehensive financial planning, and really said, hey, if your business income is getting too high, then just do a SEP IRA, something they had never done before. Do a SEP IRA and that should be good. So they reached out to us, okay? The interesting thing is they had also been working with this investment guy and who had said, make sure that you're doing, you can do backdoor Roth IRA contributions, but you can't do direct Roth IRA contributions because your income is too high. And by the way, they didn't do the backdoor Roth IRAs because the investment guy had, didn't help them get that process started. Because of this extra cash flow, and because they can't fund Roth IRAs directly, and there's some confusion about. Actually, yeah, so that's right. Sorry for the pause there. The husband was told he couldn't do a backdoor Roth IRA. That's right, because he's got a pre-tax IRA, which I have told you before, that's very tricky. And so anyway, they've got this extra cash flow, so they're just saving a couple $1,000s a month into a non-tax sheltered account, okay? So that's the scenario. Guys, this is the ideal, this is the perfect scenario for a single K. Why? Because he's got this side business. He's self-employed. It's structured as an S corp, by the way. He's drawing a small paycheck from it. It's structured where he's the only employee. It's just him, okay? In fact, his spouse works there. They're not paying her. They probably should, and they probably could. I know they could, but they probably should. Okay, I got that in the right order. And so, but even if they're both working there, they can still do a single K. Why would I bring this up? Why is this the perfect scenario? Well, let me thread the needle. the business is doing well, it's generating a lot of cash flow, and they've got other jobs. So yeah, the income is helpful and it's helping them do some things in their financial life, but there's also means they can save more, okay? But currently, they are limited in whether they can do a Roth IRA, and even he shouldn't probably do a backdoor Roth IRA because he's got pre-tax IRA dollars. So if if you were to go a full 401k route, then there'd be administrative costs, there'd be TPA costs, record keeping, those sorts of things. You'd need to do an audit, all sorts of stuff, unless you connected with a retirement plans team like ours, where we've got a PEP and can make that process a little bit easier. But typically a 401k is going to have a lot of costs and administrative headache. A single K they could set up essentially with none of that headache, okay? And it would allow him to contribute $20,500, but he's in his 50s, so $27,000 he could shelter from taxes, okay? By doing so, that would allow those contribution dollars, which I told you right now, they're doing a couple thousand into a joint account. They're getting no tax benefit on that, and all the activity on that money that they're saving, it will, have to pay capital gains tax, dividends will be taxed, all that sort of stuff. That could all be sheltered into a single K when they're currently in a high tax bracket, okay? That could all be sheltered there. And the magic is, not only would that be a benefit in and of itself, but that would bring their adjusted gross income down below the threshold where they could both contribute to Roth IRAs legitimately, not where she wouldn't need to do a backdoor Roth and he wouldn't be kind of restricted from doing it because he's got pre-tax IRA dollars, okay? If their income got up high enough where even him maxing out the single K wouldn't get them below that Roth IRA AGI, adjusted gross income threshold, then you could start paying her, which you should probably be doing anyway, and she could put in the $20,500, or she's 50 or older, so she could do another $27,000, sheltering $54,000 of income from their adjusted gross income, from their AGI. That would certainly allow them to be able to do the Roth IRA contribution. And further still, you could then take his pre-tax IRA and filter it into the single K, transfer it into the single K, while now he doesn't have pre-tax dollars in his IRA, and he can fund his IRA after tax and do it backdoor, transition it, convert it over to a Roth IRA. I threw a lot at you. These are normally jargon-free zones. I threw a lot at you because this is complicated, but just by having that, being self-employed and not having any other employees, opens you up to the ideal scenario where a single K would make a ton of sense and create a lot of financial planning opportunities. So, do you have a side business? Do you have a small business? Are you self-employed? Should you be using a single K, consider a single K, instead of just do a SEP IRA contribution that he didn't do, right? Is that you? Well, if so, before you jump out and say, well, then I need a single K, you've got to talk to your certified financial planner, okay? Let me highlight a couple of things. Number one, in this case, they said, admittedly, yeah, they just had an investment guy who wasn't giving them tax advice. When they approached him for tax advice, he had really not looked at their overall financial situation and wasn't able to give creative and collaborative suggestions. And that's the second takeaway. Their investment professional never collaborated with their CPA, never collaborated with their tax professional to say, well, wait a second, what could we do, right? They're starting to save all this money into a joint account. Is there something else? There was never that collaboration. There was never that humility to say, I might not know everything. Can we collaborate and figure out, do some tax planning here? And then to boot, the _2 needing tax planning because that income was higher, they owed several $1,000s on their tax return when they got it done this year anyway. They had anticipated that they'd owe something because they knew the business was going to have a good year, but hadn't anticipated it would be this much, and it created a tax surprise. So This is what I'm going to tell you every single video. While hopefully this idea inspires some creativity, maybe you can find yourself in this situation, you have some similarities, and instead of just saying, well, then that's what you should do. No, this is not advice. Work with your certified financial planner. That's the advice. Go work with your CFP and make sure that CFP is doing comprehensive financial planning so they can look at all 6 areas of your financial life, identify strategies, but then going through the 6 areas of financial planning, determine which of those strategies make sense to implement and which of those strategies maybe you should pass on this year and consider sometime in the future. So if you don't have a CFP on your team, you can contact one on my team. You can find us online, Korhorn.com. That's Korhorn with a K. WiseMoneyShow.com. You can find us there as well, or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.